So today we have a great episode. We're going to talk about the market. We have some really brilliant minds, and I'm excited to talk to them. We have a lot of questions. And after we speak to our panel, Chris Reyes and Matt Leone are going to lay out what's going to happen in the next 6 months to a year with our marketing and technology. They have a very aggressive roadmap, and it's going to impact all of the regions. So it's going to be a really good show, and thank you for tuning in today. So first, let's kick it off with our panel. And first, let me welcome Greg Heym, who is Brown Harris Stevens' chief economist. Hey, Greg, how are you?
Doing great, Bess. How are you?
I'm good. And where are you, Greg?
Deep in the heart of Texas.
All right. All right. Well, Greg is in Texas. Thank you for joining us today. You guys know Greg. He does the line for us. He does all the reports. A lot of our agents go to him for advice, and he's been with the company how many years?
I just celebrated my 19th anniversary. I'm still waiting for a gift. But I'll just have to keep waiting, I guess.
I'll get you something, Greg. I promise. I'll get you. So, well, welcome, Greg. I'd like to now welcome Noah Rosenblatt. Many of you know Noah. He actually used to be an agent with us. Hey, Noah, how are you?
Hey, Bess, thank you for having me here. I'm so excited.
Yeah, Noah is the founder of Urban Digs. He gives us such good market information. If you have not checked out his platform, please do so. A lot of our agents use it. We all, adore you, Noah. You're great. And thanks for joining us today. And then we have Miss Marci, Dr. Marci, right? Rossell. Hi, Marci. How are you?
I'm doing fine. How are you?
I'm good. Welcome to the lead. And you are the economist for leading real estate companies of the world. You're a contributor on CNBC, and you have a lot of great information to share with us today. And thank you for joining us. Okay. Can you hear me okay, Marci?
Oh, yeah.
Okay, good. All right. Okay, so this is going to be a conversation. I'm going to start off our first question with some economists have been quoted as saying that you're going to expect a drop in home prices as much as 15 to 20% in the next year. What are your thoughts? Do you agree with that? And this is to anyone.
Well, I'm going to jump in there, at exactly the same time. So I think that sort of if you think about the world from a macroeconomic perspective, people are coming at this from a housing affordability issue, right? And so if mortgage rates have gone to 7%, then that means that in order for the average person to afford a mortgage, home values are going to have to come down in a way that will make housing once again affordable, or at least affordable as it was, a year ago or 2 years ago. And I think at the same time, people are sort of saying, well, maybe this looks like another 2008, 2009 moment when we did see house prices fall dramatically. But I don't actually think we're in that moment right now. I think that is a situation where if a recession developed, yes, perhaps you would see home prices decline by that much. But I think that's a little bit I think on the high side. And it also depends on what market you're in. If you're talking about a national average, I absolutely think you could see a year where home prices definitely don't go up, and maybe they decline by 5%. But 15% to 20% seems aggressive for a general overall number. But of course, it depends on sort of what region you're in.
Greg, you were saying earlier that and I'm seeing this as well, but you were saying that prices are coming down. You're starting to see that.
Yeah, and the problem for a lot of the nation, and if you look at our markets in Connecticut and Florida in particular, inventory is so low, sellers are not going to cut their prices that aggressively because they don't feel like they have to. But, rates right now are still a moving target. We don't know where they're going to end up. The one thing I always point out is that, we had a housing bubble when rates were just a little bit lower than this. So 7% rate doesn't mean housing has to go down. The problem is that the magnitude and the quickness of the change in less than a year to have rates more than double is kind of shocking. And it's funny, they always seem to throw out a nice round number like 15, 20% or 25%. I agree with Marci. I think it's all about inventory. Here in Manhattan, where inventory is higher, I think people will be more motivated to cut. And we didn't see the price run-ups. But, if you look at some of the other areas, we started this year nationally with less than a 2-month supply of existing homes for sale. Some areas, we joke at Palm Beach, we didn't have enough homes to put in the windows, right?
Yep.
It can't adjust that quickly. This isn't the stock market. You just don't hit it. And this is to go with Marci said, this is not 2009, which is as much a crisis about housing and how people perceived housing. This has nothing to do with this. This is a pandemic, followed by bad Fed policy, which has led to an inflationary environment and pushed rates much higher than they needed to go.
So tomorrow we know that we're going to hear from the Fed. And so can you guys talk to us a little bit about what you're expecting and what you think, how will that impact us in the economy with housing and rates tomorrow, and what you're thinking is going to happen? Anyone?
Yeah, I'll take a stab at this. I mean, the Fed's probably going to raise 75, but that's kind of priced in. You have to think of the market as this forward, imperfect discounting mechanism. It's constantly trying to figure out where the Fed's going to go. They call that the terminal rate, right? In case you probably hear articles about where the Fed's terminal rate's going to be. And I think the terminal rate right now is about 4.8, 4.9, right below 5% for May of next year, late April, May of next year. So they can hike all the way up to that level. I think we're at 3.25 now. So they could hike up to 4, and then they could hike up to 4.5, and then they could hike up to 4.75. And I don't think you're going to see much of a change in the mortgage rates because it's priced in. So it's really not so much about what they're going to do tomorrow. It's more about what they're going to do after that. And, look, from my perspective, I know Greg is in this business. I do this on my own. In my perspective, I look at this whole Fed rates thing as a 2-part story. Okay. This first part of the story started in May, and this is the terminal rate story. This was like, oh my God, the Fed's really going to do it. They're going to hike that rate all the way up. And if you go back to May, the terminal rate was like 3% or 2.5%. It was something low. And that had a shift all the way up to 5 to where we are now. That's part one of the story. We might enter a period right now where the Fed reaches that terminal rate. And tomorrow may be that time where they come out and they say, all right, we're getting close to that. And that clarity on that first part of where the terminal is comes true. But then you got the second part of the story. And that's probably what's going to be a next year thing. What happens post-terminal? Because right now, and I'm going to stop here, the market is expecting the Fed to reach that peak and then cut rates. The market is expecting to reach that peak in May and then cut rates 5-6 times to finish out next year. What if that doesn't happen? And that's something I think we need to talk about.
Greg says that's not going to happen.
Rates will stay higher for longer. That's what I'm saying. And that's what's not priced in. So you got buckle up, put your tray tables up, put your seat backs to the full upright position, because the next couple of months on the upside and on the downside are probably going to be a little wild.
Greg, you said that's not, please, Greg, share.
Well, the Fed in their latest economic projections made no hint that they were going to hike next year. They're not planning on it. It's time for them to finally be the adult in the room that they weren't before. And they have to do what they have to do. And they cannot listen to the blowback that they're going to get, saying you've caused a recession, which they most likely will. And because they have to. Paul Volcker did it. I mean, I remind brokers all the time that bad Fed policy is the leading cause of recessions in the United States. It leads to speculative bubbles and into inflation. But I think that since they dropped the ball on, saying it was transitory and saying, we could engineer this soft landing, I feel strongly that they have. Others might disagree. But I think they better be sure that they're not cutting too soon after getting inflation under control. Remember, core inflation is still going up. It's not going down. We look at the overall headline number peaked in June. Noah talks about the change, because in June, CPI was running 9% year over year. Now it's down to 8.2, but core inflation is still going up. And that is a concern. So we shouldn't even be talking about cuts or say the word cut until we get those numbers down much lower.
But that see, the thing is, that is what the market expectation curve is thinking. And I'm saying it's wrong.
Yeah,
it's
no, I
wrong.
agree.
Just like the terminal was wrong 7 months ago when the terminal was so low. It's like that's got to go way up there, and that's what we've been through. So this is going to be one of those times where we're going to get clarity for the terminal, and we're like, we did it. We got past this first part, but the market is not pricing in the fact that those rates need to stay up there for a while, just like what Greg said.
And I'm going to argue with you guys just a little bit about those rates staying up there for a while, and here's why. I do believe we still live in what I call a 2-2-2 world. And the 2-2-2 world is 2% growth, 2% inflation, and a 2% Fed funds rate, which is consistent with all.
I hoped you were going to say 2% mortgage rates.
Oh, no. But that's consistent with mortgage rate between 4 and 5%, which is probably sort of in that world. That's what you would expect mortgage rates to sort of shake out at. Now, COVID came along and disrupted all of that, right? And it drove inflation rates down into negative territory because let me remind you that 2.5 years ago, the price of oil was zero at one point. So when that price goes from zero up to 80, that's going to give you a lot of inflation no matter what. And inflation, I believe that in the absence of the Russian invasion of Ukraine, which drove up energy prices and food prices, that double shock was really what drove us into the environment that we're living in right now.
I gotta disagree on that one, only because of the great Milton Friedman, who said it so simply: too much money chasing too few goods.
That's
M2
true.
is
and we
up.
know 60% of it was supply, or 40% was supply chain as well.
You would have had this you raised the money supply over 40%. You can't do that. Even if the supply chains weren't disrupted, you're going to have persistent inflation. It's never been done before in the United States.
But the money supply is now shrinking, my friend. And
nobody wants it. That's the problem. And inflation supply is shrinking, but nobody's buying it right now because they're tapped out. And that's the concern. And the money supply that is in M2, which is the money in Noah's checking account, in his pocket if he carries cash, that doesn't go away because you raise rates. It doesn't go away like that. And I think that's the thing that doesn't get reported on enough, is that raising rates by itself isn't necessarily going to bring inflation down quickly, even giving it 6 months to a year to work.
But hold on, because you did reference Paul Volcker, and I want to remind you of the difference in the situation today versus the early 1980s. Throughout the 70s, you had inflation build up over a 10-year period of time.
Right.
And it took rates going to 20% to make a difference. So it will probably be the case, as Noah pointed out, that the terminal rate, what it will take to start to see meaningful changes in inflation, is probably 5%. And so the question now becomes, how long do they keep it there? Now, neither one of us really know. You're speculating and I'm speculating. I'm being optimistic. You're taking the other turn. But I agree with Noah that it's markets that are basically saying they don't know. And that's giving us the sort of roller coaster ride for probably the next 6 months.
Yeah, this is such a this conversation, I think, drives everything. Like how this whole ends, whether or not it's good for brokers in Manhattan at the end of the day, like this conversation. I think something changed in May. I think there was like a regime change at the Fed, and we've gone from like they're going to provide a put on the market to like, oh, they're really actually going to do this right now, and they're going to demolish demand. I don't think the market really believed them in the beginning, but I'm in Greg's camp, just for the record, that I think that this inflation is out of the bottle because of reckless fiscal and monetary stimulus for too long, too far, too deep, in reaction to the deflationary pandemic.
That was what Larry Summers was saying all along. I mean, he was arguing, and he got criticized a lot, but he was saying that. I mean, he was saying what Greg is saying, and finally now they're listening to him. So
now they reversed it, but it takes 12 to 18 months for Fed quantitative tightening to really funnel through the system at a time when the labor market's still strong.
Yep.
And I mean, it's like people don't want to work. I mean, there's hard to find good work. So it's this weird thing that's happening right now that nobody's ever been through since, I guess, the 70s. And one could argue that even then was different structurally than this, with the pandemic and the wars and all those inflationary macro things coming in. Who the hell knows where this is going to go? But I mean, I think the next 3 to 4 months, okay, the Fed has to see the controlled demolition. That's the problem, in my opinion. The Fed wants to literally see the recession. I think they almost want to see it, and then they're going to probably reverse it.
Inflation numbers come down, right? I mean,
a lot.
Yes, they have to come down. I think they have to come down to 5% before they stop raising rates, which I'm guessing everything is pricing in that happens in March of next year. But that's 100 basis points decline in inflation every single month.
Well, you have to be specific too. We talking because the headline numbers are coming down because of the gas prices coming down. That's why core prices are still going up, because it doesn't look at that. And I think they clearly when your inflation target, your core inflation target is 2. Yes, you can't be even thinking about that stuff when even the core numbers are pushing 7% right now.
Well,
I have some positives here. Can I say a quick positive? I don't think this is it. I don't think this is the housing thing, the housing bust. I think like if we could just extend the story out a little bit to like a 5-year time frame for now, like from 22 to 26, 27 kind of thing. I think that right now we're kind of in the middle of a credit cycle. We're trying to find like this half cycle low in this credit cycle. And I think that there's going to be a reaction by the Fed ultimately at the end of this thing, which is probably going to be sometime mid next year. I think you were saying, Marci, something like that. And I think they're going to, quite frankly, stimulate and expand credit again. And we're going to go through another expansion cycle for another few more years. And then at the end of that whole 27, 28, I think we have to worry about something great financial crisis. Like you mentioned this whole thing right now is nothing like the great financial crisis. And that's what's different, right? Like the commercial paper market's not shutting down, right? You know, it's not even close. Like I have people saying, oh, the housing markets
are so remarkably different. If you think back to 2005, 2006, you had a zero savings rate in America. So people were basically refining, pulling the cash out of their homes, spending it, and they're left with a bigger mortgage. You also had adjustable rate mortgages that you don't have this time around. And you have low doc and no doc loans in 2006, 2007. Right. And banks are actually easy on the credit. And there's one more issue here that I'd be interested to sort of see how you guys think are going to play out. We know that 25% of the homes were bought with cash over the last couple of years. So that's a completely different market dynamic when it comes to, you know, the trajectory of home prices when you're not going to have this panic selling like you had in 2008, 2009, 2010.
You also had I just want to say, just to remember, during that time, you also had a lot of buyers they had signed contracts and they walked away from very big deposits. You're not seeing anything like that today.
And you had foreclosures,
That's right?
You're not going to see that now. And remember, the adjustable rate mortgage disaster never happened. Remember, everybody said all these people, when their mortgages reset, they're going to, and it worked out wonderful for them. And they're being pushed into those kind of loans again to not the same degree, because they're doing whatever they can, because, you know, it is a fair point to always point out the price you pay is fixed, but your mortgage rate is not fixed for the length of your mortgage. And if things do get better, and the key thing I think for brokers to remember is we don't have to get inflation down to the numbers we're talking about to get mortgage rates down. As Marci said, all we have to do is get it going in the right direction. Mm-hmm. It's about expectations, not about facts.
Yeah, mortgage rates have priced in the full move to 5% that Noah's talking about. And so once you get there, and then there becomes this talk of rates are going down, rates are going to, eventually the Fed will cut rates, because 5% is not the equilibrium Fed funds rate for an economy that's growing 2%. That's not right.
So guys, let me ask you, what advice would you give? So we have a lot of agents, all different regions tuning in. What advice would you give to them? I've talked to a lot of agents who are working with buyers and having a really hard time because these buyers are skittish. They're not committed. They're not sure what they want to do. What advice would you give to these agents about how to work with these buyers in this environment?
Make a informed long-term decision. You know, just like buying a stock, you know, the stock market has had a terrible year. It just had a good month, but it's had a terrible year. It's no different than any other investment. If you're informed, you know what you're buying, what you're paying, what the rate is, where that stands from a historical perspective. If it's a place you want to live in and you're going to live in for a while, then nothing should really change. It's not an easy thing to do. You want to time and wait for a bottom, but history tells you you'll never time a real estate market, because some of our markets, you think of areas like Darien where they might have, a dozen sales in a quarter because there's no inventory. You're not going to time the market. Noah knows this because he comes from this background. There are thousands of people that make their money trying to time equity markets, and they can't do it, even with a million data points to look at. So the advice, if it's long-term plan, just like I have brokers ask me what they should do with their retirement accounts now. If you're following a plan and it's a plan based in years of research, then you shouldn't change probably anything. Just know what you're doing and know that you're going to go through cycles like this. But if you're buying, I bought my house in 2006 in Long Island. Couldn't have picked the worst time from a financial standpoint to do it. I don't regret it a single day.
Love that. What about you, Noah?
I was just going to say, ask the buyer a couple of very simple questions. Would you like to buy when you could negotiate a discount on the price? That's one question to ask. Mm-hmm. Would you like to buy when prices are declining and down? That's another question to buy. Would you like to buy when there's a buyer's market? Ask him those three questions. You know what I'm saying? Because it's we were saying on Urban Digs, we were saying 4 months ago, tell your buyers now that there's going to be a rare and unique leverage event. Like we use those, I didn't know what to call it, a rare and unique leverage event that's coming up as a result of this Fed thing. And tell them now, show them the numbers and tell them this is going to go way down. And when it does, if it does, you're going to have an amazing opportunity. So guess what? It all came down and buyers don't want to take it. They do this every time. Like when you after the great financial crisis, nobody bid, right? After 9/11, nobody bid. After the pandemic, nobody bid. And every single time in hindsight, you look back at it, you're like, oh my God, you bought during those times. You ended up getting the best deals.
That's where that's where you get value, right? No, it's not what you buy. It's what you pay, that's
the market is bids and asks. The market is bids and asks, and there's a spread between that bid ask. And when the market gets illiquid and it goes down like it is now, that spread widens, and the sellers that have to sell are going to hit that bid, that gap down bid. And that's how you get an 8%, 10%, 9% negotiation or discount. And that's a buyer's market. So you ask any buyer, would you like to buy in that market, or would you like to buy in a seller's market? So like if you it's like, maybe So as a broker, brokers need to figure out the whole unbiased independent game. Brokers are just buy every time. If the brokers manage report on the market, what the market's doing in an unbiased way, and then let the clients make their own decisions based on that market leverage.
Marci, what do you think?
Yeah, I think you do have to remember kind of how we got to this point. And what I try to explain to people is that people are forward looking, just like Noah said, and they anticipated that rates weren't going to stay this low, right? So anyone who knew they were going to buy a house over the next 3 years basically backed all of that activity up into 2021 and early 2022. So you basically squished 3 years of housing market activity into 2 years, at least from a transactions point of view. And now we're living through this lull, because if everyone thought that this was the world we were going to be living in indefinitely, we wouldn't even be having this conversation. But we all know that at some point, the Fed will stop raising rates, mortgage rates will have peaked, and then they will stop coming down. So I absolutely hate this cliche, but I sort of reread it somewhere this morning, and I think I'll just repeat it. You marry the house, but you date the rate, basically. And that's the situation we're in right now, that this isn't going to be your rate forever. So if you find a house that you love, just buy it. But the other thing from a sort of managing point of view is, I said before, 25% of buyers paid cash for their house. And so this may be a time that maybe they paid for a house that they weren't all that crazy about, but they just needed to, get out of the city and buy something so they could homeschool their kids for a year. Maybe this is a time to go back to that 25% who paid cash, who don't have to worry about what rates are. They don't care, and say, hey, this may be a time to get the house that you really wanted. In terms of just, how do you manage through a period of time where, from a transactions point of view, it's going to be weaker than it was last year and the year before.
So I know this is relative to where you are, real estate wise, whether you're in Palm Beach versus New York, but let's just say New York for the sake of this argument. Do you think that sellers should rush to try to put their homes on the market now so that they don't have further price declines? Do you think now is an ample time to do that versus waiting? I'm just curious as to your opinion.
Well, when I look at it from a macro perspective, housing is expensive whether you're renting or buying. And you got to live somewhere. So maybe if you just can stand to live with your parents again for 6 months, that makes sense. But for most of us, who don't want to do that, you're going to have to rent a place. So I bet if you do the spreadsheet, you would need to see a dramatic decline in home prices for that to make sense, from a long-term point of view. And when you add in the hassle factor, I can't imagine that's going to make sense for a lot of folks.
No,
well, I think that clearly economic conditions aren't going to improve before springtime, and more inventory is going to come then. That. I always tell the brokers, deal with the facts. We can't worry about our fears and our hopes and
right.
The things that keep us up at night. Inventory has been rising, certainly relative to demand, but things are selling. I said before this when we were talking that for so many things, we want to get back to pre-pandemic levels of everything, of tourism, of unemployment rates, of this and that, people coming back to their offices. But we don't want pre-pandemic Wall Street. We don't want pre-pandemic real estate because it wasn't as good as we thought it was. Like, we see, particularly in New York, where we see year-over-year contract activity down in a given week about 30 to 50%, right? And we go, oh my God, this is so bad. And then we look at 2019 and go, wow, this looks just like that. So you can sell in this market right now. You can. And you should never put any property on in any market if you're not serious about selling it and willing to price it accordingly. But everything can sell for a price. This isn't a crisis of faith in housing. This isn't this isn't the 6 months after Lehman Brothers. This is not post 9/11 downtown. You can sell. Things are trading. So the question is, are you prepared to price it appropriately and be dynamic to the market? If you're not, you're wasting everybody's time. That's true when markets are great, as well as they are when they're bad. So yes, get it sold. There's an election next week, in case you forgot, Bess.
I wanted, that was my next thing.
I know we're going to get to that. So I think you want to sell in the market, and you know where this market is right now. March, a lot could happen between now and then. That could be marginally better, but odds are, and if I was a betting man, which I am, things are not. We're not going to be in a depression or anything, but clearly economic growth is going to turn negative, I think, at some point next year, because retail sales were flat in September. Those aren't adjusted for inflation, so people are barely hanging on, getting less and less goods for the same price.
Bess, I was just going to say, I think that there's 3 legs to this downturn so far. I think we've seen probably maybe 1.5 of the legs reveal itself so far. If I had to kind of transpose that to time, I would say May and June would be the first leg. I would say April was the peak, pretty confidently in the fact that February, March, April somewhere peak, and May is the shift month. So May and June is leg 1, and that's booked. So you signed a deal May and June. You closed, we got that. So it looks like we're down 4%, 5%, something like that. That's what the data shows. If you signed a deal in July and August, that's leg 2. That's like half complete. That's why I said like we're halfway there, right? So we don't have that second half. If you signed a deal in September and October, we don't have that data yet. So now you got 3 legs. The first leg was down, already booked. It's already in. The second leg is half booked. It looks like it's still falling, but not with the same slope. Okay, so I really question when I think about time. Q4 is going to probably show us down a little bit, and Q1 it might show us kind of trying to find a bottom. So like you look at today's market and where we are, I don't see us in active decline anymore. That's my point. We were in active decline May, June, July, August, September, and I think we're starting to see the bid come back a little bit for Manhattan. However, it's under trend. It's lower than where it should be this time of year, but we're seeing the bids come back. So we're not actively falling. We're stabilizing at this new lower level. And listen, if you want to nail the bottom, you don't look at the sales data. The sales data after the pandemic, we all know if you nailed the pandemic as an example, we could use the great financial crisis too. But if you nailed the pandemic, you bought in April and May and June of 2020, you nailed it. The bottom did not show itself until early 2021, about 7 months, 8 months later. In 2009, if you bought in February and March of 2009, you nailed the bottom. But the bottom didn't really reveal itself until about late 2009, early 2010. By then, the market's already rebounding and you're at a different sentiment in the actual market. So if you want to take advantage of the market and get that gap down bid, you got to kind of buy on the way down when the fear level's high, or at least before you start that recovery mode.
And you don't know you're at the bottom. I mean, you don't know it's the bottom until it's past, but like you can't until only time gives you that. And now you don't know.
And right now, Q1. So like Q1 comes out in April. That to me looks like that's, and you know what? That could extend to Q2 if there's another leg in the cycle. If we see deal volume stay below trend, we might be still in minor active decline.
Okay, so I know we're going to touch on the midterms. So the midterms are next week. I'm curious to get your insights as to what you think, how this could impact us in the real estate market, good, bad, or indifferent. And we'll keep politics out of it, but I would just love to hear your opinions. There's some governor's races that are very meaningful happening. Who wants to start off on talking about the midterms?
Well, I just want to say that I think at a national level, sort of the consensus appears to be that the House and the Senate probably will both swing in the other direction, which means from a national policy point of view, you just go back to gridlock, like beautiful, fantastic, the gridlock that we had in 2019, basically. So you go back to a divided sort of executive branch, congressional branch, which means not a whole lot happens at the national level. But I think one of the things that we've discovered over the last couple of years, and we seem to be in this sort of moment where power is devolving down from the national level to the state and local level, given some choices that have been made by the Supreme Court. Which means suddenly, even though we all like to sort of watch national races because it feels like football or something, when it comes to what's important for your life and your business, it's going to be happening at the state and local level. And I think that people need to recognize that this is that time when we really need to be paying attention to those races.
And I think obviously we have a big one here in New York, but the thing to keep in mind is no matter what happens, the legislature is not changing in New York. So just like Marci said, don't expect things to change, a lot of dramatic changes nationally. Don't expect it in New York, because even if Lee Zeldin wins, the Senate can override any veto he issues very easily. So don't expect any changes to rent stabilization or tax laws. Expect to see things like the pied-à-terre tax still being talked about and property tax reform being talked about, all that stuff. So, I mean, a lot of people just try to see how much they can do with executive orders these days to kind of bypass the whole thing. But I think gridlock is something markets are okay with on a national level because it gives a certain degree of certainty that not much is going to change. We'll see what happens, particularly in New York, if that election does swing that way and see if that dynamic. Obviously, we know one thing, things are going to get loud and nasty because that's unfortunately just part of politics these days.
Yeah. Noah, any thoughts on the midterms?
I think Marci and Greg nailed it.
Okay, good. And then we have like 3 minutes, so I would love to just shift for a second. There's a lot of talk about recession. Share with us, are we in a recession? If not, will we be? And what do you think? Why do you think that we're not, if you think that we're not in a recession? Who wants to begin? Greg?
All right, I'll go first. We're not in a recession.
Mm-hmm.
Again, there's been talk about the definition of a recession, which a lot of people believe is 2 negative quarters of GDP growth back to back. That was changed years ago. You talk about knowing bottoms. The way recessions are dated by the NBER is they wait like a year after it happens and go, yeah, that was a recession, using very vague terminology like a marked downturn in hiring, an economic growth that lasts more than a couple of months. That's the general framework of the definition. But the missing ingredient, obviously, is an elevated unemployment rate.
Yep.
That's why we don't even have stagflation. Like a lot of people say, this is stagflation. It's inflation without growth. That's not true, because during periods of stagflation, the unemployment rate is elevated, not near a 50-year low. And by the way, the JOLTS data came out this morning. Job openings are up, not down. Weekly jobless claims are in a narrow range in the low 200,000s. We've even seen improvement here in New York, which has lagged in the unemployment rate lately. So we're not in recession any way you slice it.
Will we be, Greg? Do you think we're going to hit a recession?
Yes, I think we will. I think it will be brief. If you remember, the Volcker recession of the early 1980s was brief. I put something in the line last week that the average, recession tends to be around 10, 11 months since the Great Depression. So I don't think it's going to be that long. Again, this is self-inflicted. We're doing it to break the back of inflation. Obviously, companies still want to hire a lot of people, and there's a lot of jobs to fill. And people do have money to spend, at least for now, if prices can come down. But I think that fighting about whether or not in recession, or kind of I know it when I see it definition, we know that consumer spending is still positive. I think it was up 1.4% at an annual rate. That's very weak growth, and it's headed in the wrong direction.
Noah,
Marci? I'm in agreement. I think that we're not right now, but I think it'll end up being proven that sometime next year it will hit. I'm more of a trader, so I have a different perspective than Greg. For better or worse, it could easily be worse. I look at the equity markets. I'm looking at the credit markets. I'm looking at credit spreads. I'm looking at different things that don't necessarily in an economic way define a recession. I look at this inflationary bear market as having 4 stages. And we're in that second stage where there's a lot of bear market rallies in the second stage. I don't think we've gotten to the third and fourth stage, which is more of the panic, fear, desperation kind of a thing, unfortunately. And I think that's like kind of more painful to us as a real estate marketplace than the recession label being hit for 5 months. So I worry that next year is going to reveal those latter stages of those consequences. I don't think we're going to get out of it this easy, quite frankly.
Marci, any thoughts?
Well, certainly I agree with everybody. We're clearly there's no recession in the data right now. And people will say all the time, oh my God, yes, we're in a recession. And then you say to them, well, how's your business? And they say, oh God, gangbusters, never been better. Right. So we're in more of this emotional recession, sort of a media kind of recession where everybody, and one of the things that makes it so different is, for instance, Europe is entering a recession, and they will most likely have a pretty deep, severe recession this winter because of the energy shock that they are facing. So we need to remember that recessions most of the time happen because of some unexpected event that no one was anticipating that shocks the economy. And so COVID, of course, caused a deep and short recession, satisfied the shock no one was expecting. The financial crisis of 08-09, the death of Lehman Brothers, AIG that you guys referenced earlier, shock no one was expecting. You could say I knew house prices were going to go down, but you didn't know when, right? So you look back to 2000, and that was a dot-com boom and bust, right? So the bust in technology stocks. I would say that history may look back at this one and say, maybe there was a boom in crypto stocks that turned into a bust that affected the finances of a really small group, and you got some sort of spillover effects into other markets, coupled with a rising interest rate environment that isn't particularly shocking. I mean, I don't think any of us are surprised that the Fed is raising rates. So you tend to have something unexpected to cause a recession. And all of this looks like what people have been expecting to happen for quite some time. So I think you can get flat economic growth, but given how strong labor markets are, I'd be hard pressed to see an outright recession. Doesn't mean you don't get flat growth, but that's not an outright decline.
Good point, Marci. It's a good point. Well, I guess we're going to have to see. None of us really know for sure. These are all just predictions. And so, but I do want to say thank you to the panel, for everybody, for coming on, talking, sharing with us. Very insightful, very helpful. Noah, Marci, Greg, thank you for being here today. And we'll see what happens. Well, maybe we'll have you guys back to see we'll see in 2023 and see what you have to say. See where we're up
to call the bottom. We'll be back.
Yes. Right.
You got that right, Noah.
Thank you, guys. Greg, safe trip home.
Thank you, Bess. It's really up to the pilot.
Here we go.
Bye, everybody.
Bye, guys.